Hi, welcome to 5.01 Taxes and Tariffs 1. This is starting on slide 12. Taxes on wealth. Taxes on wealth are taxes on assets such as real estate, stocks, jewelry, and art. All three levels of government collect taxes on wealth, but local governments typically depend on them the most for collecting revenue. The two types of taxes on wealth are the property tax and the capital gains tax. Property taxes are almost always the main revenue source of local governments. Local governments use property tax revenue to pay for public schools, local road upkeep and repair, snow and garbage removal, and many other municipal services. Property taxes are based on the assessed value of a piece of property. The government uses a method to calculate the value of the property and then taxes it based upon a percentage of that value. If the assessed value of the property goes up, the tax goes up. If the value declines, the tax decreases. Taxpayers pay capital gains tax on profits made through the sale of assets. Capital gains taxes are paid to the federal government by the taxpayer at the end of the tax year when filing an income tax return. The amount of revenue the federal government receives from capital gains taxes is much smaller than the revenue it receives from income taxes. In fact, capital gains taxes usually comprise less than 5% of federal revenues. Tax breakdown. The federal government collects between $2 and $3 trillion every year, almost exclusively from taxes. So, where exactly does all that money come from? Use this pie chart to learn more about the tax breakdown. Hover over the image for more information. Tax breaks. People usually like to keep as much of their money as possible, and there are ways to adjust how much a tax a person must pay. There are many types of tax breaks allowed by the IRS and other taxing authorities. Tax breaks can reduce the amount of taxable income. Tax breaks may also simply reduce the amount of tax owed by providing a tax credit. Tax breaks complicate the tax code and the process of filing taxes. But tax breaks are important to taxpayers because they significantly reduce tax liabilities. Some tax breaks are available to all qualifying taxpayers regardless of income. One of these is the exemption, which reduces the total income that is subject to taxes. Exemptions are given for various types of expenses. For example, taxpayers who support children under the age of 18 are granted a dependency exemption. Other tax breaks are based on economic considerations. Some help the poor, some help the rich. For example, people with high medical bills, mortgage interest payments, or child care costs can subtract these amounts as deductions, reducing their taxable income. Business owners are allowed to take many deductions for business-related expenses, such as capital purchases and gas mileage on business trips. Homeowners can deduct expenses related to purchasing and owning a home. Charitable donations are tax deductible. Another tax break is the tax credit, which directly reduces the actual tax amount owed. Unlike an exemption or deduction, a tax credit reduces the tax payment required. The federal government provides a number of tax credits, including credits for home improvements and cars that improve energy efficiency. Another tax credit is the earned income credit, which reduces the amount of income tax paid by low-income taxpayers. Taxes on consumption. Taxes on consumption are taxes collected from customers when they buy certain goods and services. Most consumption taxes go to state and local governments. Two main types of consumption taxes are the sales tax and the excise tax. Both types are imposed at the point of sale. Sales tax is added to the purchase price of a wide variety of goods and services, including clothes, haircuts, movie tickets, books, cars, hotel rooms, and air travel. In many states, necessities such as groceries and prescription drugs are exempt from sales taxes. A sales tax is charged as a percentage of the price of the good or service. Sales tax is collected by retailers at the point of sale and later turned over to the appropriate state or local government tax authority. Sales tax rates vary from state to state, county to county, and city to city. There is no federal sales tax. Excise tax. Excise taxes are taxes on the sale of specific goods and services, such as gasoline or cable television, or taxes on specific activities, such as hunting or gambling. Unlike sales taxes, which apply broadly to all consumer purchases, excise taxes are targeted at particular types of consumption, and they are generally used for specific purposes. For example, gasoline excise taxes are paid by drivers when they purchase gasoline, and most of these taxes are used for building and repairing highways and bridges. Excise taxes are charged on many things, though one common form is the luxury tax, a tax charged on items such as personal airplanes, expensive cars, fur coats, and jewelry. Luxury taxes may or may not reduce demand for luxury goods, depending on whether they deter a wealthy customer from making a purchase, but these taxes give the government a way to collect revenue whenever someone makes a big ticket purchase. Another type of excise tax is called a sin tax. This is a tax on goods or activities that are considered damaging or detrimental, such as cigarettes, alcohol, or gambling. By raising the cost of engaging in these harmful practices, sin taxes often succeed in reducing demand and limiting unhealthy or otherwise damaging behavior. Distributing the tax burden. Taxes affect everyone, but the tax burden is not evenly distributed throughout society. When tax rules are made, the government also makes decisions about who pays what. Because nearly everyone would prefer to pay less and have others pay more, there is an important question. How should the tax burden be distributed? Most people agree that taxation should spread out equally, but it is difficult to get taxpayers to agree on how to do that. If all taxpayers were equal, with equal income, wealth, and consumption habits, it would be easy to distribute taxes fairly. But taxpayers are not all equal. Some taxpayers have very low incomes, while others have very high incomes. Some taxpayers own many assets, while others have none. Some taxpayers have dependents, while others do not. The variation among taxpayers makes fair tax distribution quite complicated. To try to create fairness and inequality of the tax burden, governments employ multiple taxation methods. Progressive taxes. Some methods of taxation are progressive. Under a progressive tax system, tax rates increase as income increases. In other words, taxpayers with more income pay a high percentage of taxes than taxpayers with less income. This method of taxation is based on the ability to pay principle. The idea behind this principle is that people should be taxed in accordance with their ability to pay, usually as measured by income. Federal income taxes are an example of progressive taxation. The federal income tax rates increase progressively as income increases. This is achieved through the use of income tax brackets. By grouping incomes into tax brackets, people with different incomes pay an increasing percentage of tax as their income rises. The total amount of federal income tax a taxpayer pays depends on where he or she falls in the various tax brackets. In the United States, there were 6 tax brackets as of 2012. Taxpayers in the lowest bracket pay 10% of their income in taxes, while income in the highest bracket is charged 35%. Regressive taxes. Another taxation method is the regressive tax. Under a regressive taxation system, tax rates decrease as income rises. In other words, regressive taxes place a heavier burden on taxpayers with lower incomes than on those with higher incomes. The main principle behind regressive taxes is the benefits received principle. The idea is that taxpayers who use public goods or services should bear the cost in proportion to the amount of benefits received. This taxation method ignores differences in taxpayer income and focuses on relative use and benefits gained as the main criteria for taxation. One example of a regressive tax is the sales tax. For every purchase, taxpayers pay the same amount of sales tax. If one taxpayer earns quite a bit more than the other, then the sales tax takes a smaller portion out of this larger income. That makes this tax regressive because the tax as a percentage of the consumer's income decreases as income increases. The economic effects of taxes. By putting taxation systems into place, governments can generate revenues. Tax revenues allow governments to provide the basic elements needed for a functioning economy and a civilized society. Without taxes, the store of public goods and services would be much smaller, and the economy would be much poorer. Governments can shape the behavior of individuals and corporations by using taxation to raise and lower the prices of goods and services by taxing certain items while leaving others untaxed. Taxation also affords governments a powerful tool for managing the economy. The government can also change the economic status of different segments of the population by shifting tax burdens among the different income levels in ways that increase or decrease economic equality. Taxes are fundamental to strong economies, and they allow governments to provide society with public goods and services. Taxes are the price everyone pays for living in a civilized society. We're going to end this recording at slide 20. The next recording will pick up at slide 21. Please let me know if you have any questions or concerns about this information. Have a great day.